Welcome, everyone. Thank you for joining us today. This is part of our channel chat series that we do with our data partners, IDC, and we try to do these every couple of months to share some new information for you guys based on the data collection that IDC does. We will have this information for you. If you guys need any additional information about the data partnership and the reports that are available, feel free to reach out to me or Frank. Without further ado, I'll go ahead and turn it over to Frank to make some introductions and opening remarks.
Thank you, Kavita. I appreciate it, and welcome everybody. Good afternoon. And as Kavita said, this is our third quarter overview with IDC, and we're thrilled to have it. There'll be three speakers today. I will be quick, and then I'll turn it over to Lauren, who typically runs these, and Lauren will take us through the information from third quarter distribution tracker. And then what we like to do every one of these is we like to have a guest. And today we've got Mario Morales, who's responsible for the IDC semiconductor research. And of course, we all know that's a really important topic and one that we've been dealing with for quite some time. And we're looking forward to Mario providing us with some insight on what's going on in that space. So with that, let me just quickly talk about a couple of other things that we've got going on here at GTDC. First is we just released a new research report. It's available on our site, gtdc.org, and it's in our Knowledge Hub. And we've titled it Distribution as a Recession Countermeasure. Many of you know that, there's a lot of discussion about the economy, the macroeconomy, what's going on, et cetera. And what we've done is we've put together a guide that talks about how vendors can use distributors more effectively to go to market. And you could do it in any environment, but certainly in a potentially recessionary one, we think there's some things in there that you'll find very helpful. Download that and take a look at it. And then the other two things is we're really excited to announce that we've finalized the dates for our next two events. So we've got the first one coming up in February. That's our North America Summit. We're going to do it the 8th through the 10th in San Diego area. And we're really looking forward to a great event. In fact, one of the things that will happen is one of the keynote speakers will be Crawford Delpreet, who's the president of IDC. He's committed and he'll be out there to talk about what his view on the industry, state of the market, and what IDC sees going forward. So that's going to be exciting. And then later on in 2023, we're going to go back to Europe and we'll do our European event in the Amsterdam area, June 13th through the 14th. So with that, Lauren, let me pass it back to you because I know you got a lot of good information to pass along today. Thank you.
Thank you, Frank, and thank you everybody for dialing in. So the agenda we have for today is here. We're going to start with some macroeconomic overview. Then look at the distribution data, top line, and some product detail specifics. And then our guest, Mario Morales, is going to give us a really nice update on the semiconductor and supply chain trends. So lots to cover. Let's jump right into it. As Frank mentioned, there's a lot of discussion happening around the macroeconomic environment. We're sort of inundated with it daily, but we've put together a summary here. Inflation and persistent inflation is really the dominant story right now. Along with that comes tightening by the Federal Reserve in the US. There's obviously similar actions taking place in other regions with their counterparts. A notable change this round from last quarter, and certainly even just a month or two ago, is the signs and related factors seem to be deteriorating a bit. So unemployment has been a highlight for a while, but we've got depressed stock prices right now. The housing market slowed down, retail, energy prices, confidence, all of these things are deteriorating, and that that sets us up for a more pessimistic outlook. On the global front, weakening trade partners. So not only are many of these are other countries facing similar economic headwinds, but they're related. So one country, whether it's the US, demand reduces, then Europe and Asia can't sell as much to us and vice versa. So it's all interlinked. Energy from Russia, election policy changes is another area that, I think there's a lot going on in the world that's creating uncertainty across regions. And so that, I think, is a significant trend right now. And then COVID in and of itself has new variants and significant potential for shutdowns or variants or other things. And I think in a way it's a nice, it serves as kind of a general wild card that, there could be something else that pops up that disrupts the market as well. And that seems to be a key story or theme that we've had over the last couple of years. Hopefully it'll settle down soon, but probably not in the next year. So all those factors are related. The other thing, this is some survey, this is actually, Black Book summary. I'll get to survey results in a moment. But what we've seen so far has really impacted the consumer segment the most. So we saw this large spike in consumer devices in 2021. And now we've got a flat market and actually declines in some of the markets, but overall spending is still about flat in 22. And enterprise and service providers are doing much better so far. Having said that, so when we look at that by tech category, we've got the baseline in sort of light blue and a recession scenario in dark blue. You can see that devices is the only category that really goes negative globally. Even in the recession scenario, all the others dip down, and the enterprise and as a service segments in particular are more resilient. Having recognized that, strength by industry and relatively good position, there's a lot of anticipation of a slowdown. So this is our Future of Enterprise Resiliency survey results from September, results from about over 800 IT decision makers. And, almost 3/4 of them are expecting a recession in the coming year, with the highest concentration of those in North America. So, significant shift towards industry impact and beyond consumer. When we look at IT decision makers, we can see in the orange and the yellow or lighter orange that there's some anticipation of reduced spending on IT. And green, you've got a much smaller potential for positive impact. Having said that, there is a silver lining, which is when you get to the C-suite level, there's a bit more willingness or anticipation of investments, recognizing the value of IT. So, as with many things, there's multiple perspectives, and I think this is a note of optimism really in the outlook. Summarizing the overall IT outlook, this is a global view from our Black Book. In green, we have our GDP spending in the solid line with a recession scenario in the dashed lines at the end. And in orange, we have total IT spending. So, you can see the ups and downs. Another clear takeaway is that IT spending is consistently higher than GDP growth, and that even in a recessionary scenario where we've got our short-term low in 2023, overall, we're still expecting positive growth and a relatively quick rebound. So I think, it's a challenging environment, but there is, the magnitude of the downturn is expected to be minimal. And I think the recovery, we can see the light at the end of the tunnel. So from there, let's shift into actual North America distribution tracker results. I want to start with total spending. This is weekly data in millions of dollars in blue and year-on-year growth in orange. It's hard to pick out, but actually we just hit a weekly high in week 39. So this data goes through week 40. of 2020. This is the end of September data. And that was a weekly high for the last several years, and probably ever. So that's a very nice note. You can also see in the orange line that volume is stabilizing a bit. The growth trend is not quite as volatile as it was, particularly in 2021. But you can also see that a little bit here that growth is slowing down, and we'll see that better in some of the subsequent views. In this view, this is a rolling 4 week, so a proxy for monthly data. You can more clearly see the low in 2020 and the rebound in 2021. The 2022 is, got some ups and downs. We'll see a better view of that trend in a moment. This is a rolling 13-week view, so a proxy for quarter, and this really normalizes the trends a bit more at this level. The white lines indicate Q4, so we've clearly ramping up by the end of the year, and we've got a clear bottom in 2020, clear rebound in 2021. First half 2022 actually extended that. I think overall spending was quite strong. And frankly, even second half 2022, while it's down from the peaks, is still growing very nicely. So distribution is holding up quite well. The middle chart here is a combination of current year and prior year. If you dialed into past calls, I find that this is a good way to kind of normalize for depressed markets and rebounds, or potentially booming market and then a busting market. And the trends, particularly the growth trend, is much smoother. And now that we're getting into later 2022, you can see that growth trend start to tick down. So, further corroboration of the macro and trend, as well as the resiliency of the distribution channel, in that we're still growing positively. Finishing out this series, I'm going back to the weekly data on the left. This is the same growth chart, but I've added a polynomial curve to kind of illustrate the trend. The high there in blue and the lows in red give you an idea of the macro trend. We are up 8% year to date in 2022, but slowing. So the higher growth was in past months. We're actually still ahead of the last few years. So NADT IT spending was up 7% in 2021 and 3 or 4% in the prior 2 years. So we're still at a relatively higher level of growth. Again, using the current versus prior comparison, now on a weekly basis with the trend line, you can see that the peak is, again, still in earlier 2022. And what I would take away from this really is that from this perspective, you had more steady growth from the bottom in 2020 up through the peak in 2022. And that we've got a clear inflection point where we're starting to decline. So really good example of how the weekly data provides, the latest pulse and what's happening in the market daily. So with that basis, let's kind of shift gears and look at overall tech spending. The distribution is fairly similar to past quarters and months and weeks. You've got a couple of technologies changing place. On the right-hand side, you can see the relative growth of each of these. So very notable from my perspective that only peripherals and accessories had a notable year-on-year decline, down -9%. We did have small declines in AV and storage, but the rest of the categories are growing quite nicely. So at the top end, you can see we've got a little bit stronger growth from services and networking. Also, software is fairly enterprise focused, so higher growth there. When we get further down the stack, consumer electronics is relatively high, again, because of mobile phones. And this is really a result of low volume the phone market going into distribution. So if you've seen our device press releases, both PC, tablet, and mobile phone markets globally are all slowing down. And possibly one result of that is that some of these companies are distributing inventory into the channel as a way to help find buyers and manage that inventory. So we've seen a notable spike in consumer electronics and mobile phones in particular. Also carrying on from prior presentations, this is a comparison of the US and Canada growth trends. In past presentations, the point really was to highlight the different phases of COVID response. So Canada in blue recovered much faster and had a higher rebound initially. And as a result, they kind of ran out of gas and slowed down in 2022, as opposed to the US that took a little bit longer to respond to COVID and hit the rebound in the middle of 2021. Again, had a peak in earlier 2022 with easy comparisons. And now we're basically seeing those growth rates align again at the top level. So not to say, well, I mean, clearly the COVID phase shift was a significant factor. It's not the only difference, but I think it's a good example and of where underlying factors are aligning again. Let's spend a minute on personal computing. So top left, you've got a rolling 4-week view of distribution by product. There's a couple takeaways. I think most of the recent history, this is 2022, is in positive territory. The most recent weeks, week 38, 39, and 40, are negative for all of the product categories. But if you look earlier in the year, you can see that they're not the only times when shipments have been negative. So the gray line at the bottom is tablets. That's actually been negative growth at about the same rate for much of the year. The blue line, which is notebooks, is 2/3 of the revenue in this data set. So that's pretty significant. We had our peak in a couple of months ago, but you can see actually that we saw negative growth around week 19 and 20, and also around 5 or 6. So in the current cycle, we're down for about 5 weeks that are actually year-on-year growth below 0. But earlier this year, we had 17 weeks that were below 0. So by no means are we kind of off the chart or diving into a hole. I think this is market fluctuations and all the other dynamics facing the market. Similarly, in 2021, we had a full 12 weeks that were in negative territory. That was right in the middle of most markets having a recovery. So some of the volatility just that we see in the data. On the bottom, you can see the same data by vendor. So Lenovo has the largest share, 28%. They had a pretty significant surge in August, growing about 20%, but they're declining now. If you look at that blue line throughout the year, they had a surge around March, February, March, and they had a significant, more pronounced decline than what we're seeing right now, late January and early February. HP is the second largest vendor. They're in orange, kind of similar trend with a peak a bit later, like April, and then May and June. But they had declines sort of in between that and at the beginning of the year. So significant number of weeks of negative growth. And then finally, Apple is in gray. You can see at the top of that chart, they are the third largest vendor, and they've really stood out in terms of growth. You can see peaking over 70% in around the middle of this year. They were also near 60% at the beginning of the year. they've had a really good uptick of the M2 processors and general responsiveness to their products. Supply issues have kind of slowed them down a bit, but we're expecting that to kind of be resolved as we go into future months. So the second largest category in the NADT data is software, and that continues to grow. We've tried to identify some opportunities for distribution here. So overall growth of 8% is down from double digits in recent quarters, but it's up from 6% in 2021. So different phase from consumer devices. Well, both software and services are more project oriented, some of particularly services, streaming revenue. And so those hold up fairly well in a slowing environment. This is a bit slower than the overall software market. We had 16% growth there globally. So anyway, a little bit more robust. I think that reflects smaller participation from distribution than there's a lot of software categories that are difficult for distribution to address, but there's some potential there. System infrastructure software is the bulk of the NADT revenues with 55% about, but it's a smaller part of the broader market, about 25%. We saw 9% growth in Q3 versus 16% across all channels, so a little bit slower. But we've got more of the growth in the overall market, and a smaller percent for NADT translate to some potential for distribution to further penetrate that market. We saw applications as one category, and application development deployment, ADD, another category, are just 16 and 7% of NADT respectively, but they're 75% of the broader software market. So, participating in that, I think there's kind of a room to grow. It's the fastest growing of the broader software market, and so something that I think distribution should look at. One of the things that we see in this environment is there's a skills shortage. If unemployment goes up, maybe that will alleviate a bit, but right now, that remains a particular factor. Actually, it's always a factor in the favor of distribution. So anyway, I think good opportunities there for distribution and clients to kind of grow software revenue. Let's shift to services. Services is a little bit similar to software, enterprise focus, lower penetration of distribution. You can see on the top left, we have overall market growth trends. What really stands out is the growth of other services, both support services, which is traditionally the bulk of this distribution spending, and warranties have been more muted growth. But overall, we've seen very resilient and solid trend in services. So the market hit a low of -7% in early 2020. The recent quarter was up 19% year on year. So no significant sign of the slowdown from economic headwinds here yet. The support services were flat, so not as exciting from a growth perspective, but they're still quite central in overall services. Because of the growth in the other categories, the share declined by about 10% over the recent 4 years, while other services basically picked up the majority of that. So we see some opportunities in the following services: so cloud migration, hybrid work, as a service offerings, security and protection, predictive and prescriptive support, and outcome or customer success related support initiatives. So all categories that you would want to keep an eye on. The bottom chart here shows you the top 5 brands in this is not the top 5 overall. It's among the top 5 vendors in each of these categories: support, warranty, and services others. And I've selected the companies with the highest compound annual growth rates, and they're quite high. So within this category, you've got brands that have over 4 years increased revenue. They've tripled or up to almost 50 times in that period. Of course, that depends quite a lot on the volume that you start with. But these are some pretty significant brand names here, and they're also filtered on the top 5 in each category. So these are not small guys. 4 out of the 7 that I've highlighted here have increased quarterly revenues in a single service category by over $90 million. So anyway, examples of standout success and the potential within distribution and within services in particular. So anyway, sorry, I realize I kind of went through that. I didn't mention it before, but hopefully that's a really good overview of top distribution trends in the economy. Mario is now going to take us through some of the semiconductor trends. So hopefully I've left you with enough time. Thank you.
Hi, everyone. Thank you for inviting me to this session. I actually have about 40 minutes of content that I'm going to try to go through in less than half the time, but I structured my presentation to give you sort of three specific areas. One is talking about the near-term trends that we see for the semiconductor market, what I would consider more midterm trends, so beyond a year, and then more long-term trends that I think are structural to the semiconductor space as well. So when we go into the near-term section, it's really right now we're going through an inventory correction period, specifically for the semiconductor space, and a lot of that is being led really primarily by the fact that over the last couple of years, we've been building not just capacity, but demand has been very strong, especially after the COVID pandemic and really also going through the supply chain constraints that we've gone through. So it's been really a couple years of change that we've seen in the space. We've gone from record level of capital spending to long-term agreements between fabless and foundries. That's when we were in constrained positions. Of course, there was higher wafer prices to align with the growing number of costs because of inflation. And utilization rates were around 100% for most of the leading players, especially in the foundry space, which has been a good place to be if you're in the space. Strong demand for legacy nodes as well has come out to be one of the most important things that we've learned from the pandemic, especially because over 2/3 of the entire industry's capacity still is catered to a lot of the legacy technologies. And then just to top this off is that the semiconductor industry has gone through a very strong period of growth. I mean, we saw growth even in the initial pandemic year of 2020. That growth essentially doubled in 2021. But as we go into 2022, we're definitely seeing some change. And the first half of the year, we are still seeing very good growth on a quarterly basis. So if you look back to just Q1, even though during that period of time, we began to see a correction in terms of demand, in terms of inventory in markets like smartphones, that then started going into the second portion on the demand side for PCs and inventory correction now that we're seeing in the PC space. The first half of the year still grew from a semiconductor standpoint, but the second half is decelerating in line with what I would say is this correction that we're seeing and this weaker demand environment. So our expectations are that we are going to see a double-digit unit volume declines in smartphones and PCs. That's what we factored into our numbers that I'll share with you. A lot of the markets are definitely consumer-facing that are seeing the most weakness. The inventory correction, as I mentioned earlier, began in this first quarter. Some of the OEM brand started doing more of a broader correction that we're seeing now in the second half of the year. And then it doesn't bottom until we expect into the first half of 23. So what this has resulted in is a rapid memory pricing erosion that we're now seeing now that likely began last September, but really accelerated as we got into the May and June timeframe. And we're expecting that the memory section of the total semiconductor market will probably be the ones that are going to feel the deepest change, especially this year and next. And in some cases, some of this will trickle into 2024, just given the amount of capacity that we're expecting in that space, and just the deterioration that we've seen in some of the key markets that drive memory demand. Just as an example, normally in the DRAM space, we tend to see about 15 to 17% bit growth every single year. That's pretty consistent. NAND, you tend to see more like 30 to a little bit more bit growth per year. This year, as we started seeing this deceleration, we're now expecting that the year will end somewhere in the 1 to 2% bit growth range for DRAM, and only in slightly more than double digits for NAND as we go through the year. So we're definitely now seeing that change that's happening from a demand standpoint, and because of the correction that we're seeing, we're also seeing an impact to pricing. I think that some of this pricing will then begin to attrition also very soon. You're already starting to see it with some of the earning reports from Intel and from AMD yesterday. You could see that these companies are definitely using price as a way to maintain the order rates that they want to maintain with their customers, even though the customers are now trying to go through a period of correction. I think the capital spending cutbacks is a very fast reaction that you're starting to see from suppliers as well, specifically in the memory area today, but you're going to see it more from the foundry suppliers as well. When TSMC announced their numbers recently, just a few weeks ago, they basically shaved about $4 billion of their capital spending. Some of it was really because of the fact that they couldn't get the tools anyway because of the long lead times in that market, but also just because they are also adjusting to the changes that they're seeing from their customer base. And TSMC is one of these companies that has hundreds of customers that are fabless companies primarily, that are part of their overall ecosystem. Utilization rates are expected to fall for foundries and bottom sometime in the second quarter of 23. And we're also now starting to see that even the cloud service providers, even though the growth rate projections for the remainder of this year and looking at 2023 still remain positive, the cloud service providers are also recognizing that the market has changed. And so they're going back to their suppliers and pushing out orders or renegotiating contracts that they have in order to take advantage of the better pricing environment. And I think you're going to see more and more of that. We're starting to see now that even some of these long-term agreements, some agreements that are 1 or 2 years out now, some of these fabless companies are trying to work with some of their suppliers to renegotiate some of those pricing, given the amount of inventory that they continue to hold. So as we look at this year, and we end this year, we're going to probably end at half the growth rate that we initially targeted at the beginning of the year. So at the beginning of the year, we thought that the semiconductor industry was going to grow about 9.7%. We're now expecting that as we close this year, we're going to look at 4.5% growth for the market. And just one last point that I want to leave you with is that next year is when you're going to start seeing the U.S. CHIP Act begin to issue subsidies with provisions moving forward. So you'll start seeing some announcements by chip companies in the ecosystem that will talk about some of the subsidies and tax breaks that they're getting from the government in the U.S. for driving more regional sovereignty. And the interesting thing will be how these companies implement that investment, and whether or not they're actually going to even take the subsidy, given that it comes with many provisions, including one that I think is very interesting that I'll talk about later, which is a 10-year agreement that you're not going to invest in China in terms of leading edge technology. So can I go to the next slide, please, Lauren? So I won't spend a lot of time in this, given the constraints I have in time, but we're clearly factoring in a recession in our numbers, and you'll see that as I go along. These are just some of the recent highlights in terms of news. Next slide, please. This is a similar chart that Lauren showed, and it comes really from our Future of Enterprise Resiliency survey that we do each month with CIOs and CTOs to gauge where they're at in terms of their spending within the enterprise. And you can see that 72% of the industry is expecting a recession. Now, it depends on how long they think it'll last. Some folks believe it starts at the beginning of the year. Others believe it's starting since September. But the point is that we are factoring in a moderate recession for the industry, and that's what's impacting the numbers that you'll see next. The next slide, please. This is something that Lauren showed also too, just the pessimism of a lot of the tech buyers. And you can clearly see that it does vary by region, but we're pretty close to the variance overall as an average in terms of whether or not they factor a moderate or severe recession. I think that when you go into Europe, you're going to find that they're most pessimistic there, especially in terms of the severity of a recession. But they've already been experiencing it, given the war in Ukraine with Russia. And the impact that it's had on the supply chain, on energy prices and inflation. Next slide, please. So as we look at the semiconductor market, the short-term or near-term trends that I'll point out here is the fact that I talked about that we're seeing half the growth rate that we expected to see. We think that the market will decline about 11.1% on a year-over-year basis in the second quarter of next year, marking what I would call the bottom of this cycle and the broad inventory correction that we're currently seeing. We think that 2023 will actually shrink. Our original forecast was to see about 5 to 6% growth in 23. We think now that it's going to be about 5.3% decline. It could get a little bit worse depending on how fast customers or suppliers are able to adjust their spending and adjust the supply overall of the market. But some of the factors that I wanted to point out is that this scenario does assume a moderate global economic recession in 4 to 6 quarters. We do believe that we will return to year-over-year growth by the fourth quarter of next year, and will continue to gradually improve for the semiconductor industry as we go into 2024, with the only exception being memory. I think that the memory sector definitely will see a lot more pain. We're seeing that from a price erosion standpoint, but given the amount of supply, it will take some time. So this is the slide where you can sort of see the short-term outlook that we have for the semiconductor space. And the key point here is that when you look at this slide, you're going to see that the first half of the year, we were still seeing growth in the market. So we were looking at peaks that we saw in Q4 of 21 and in Q1 of 22 of about 159 billion of quarterly semiconductor revenue. And so that equated to about 20.5% growth in Q1 of this year, going down now to what we're now reporting about 10.5% Q2 growth. But we clearly see a very rapid deceleration as we go into this quarter and you start seeing companies report. I think you've already heard Intel. You'll hear about Qualcomm later today, but you can sort of see that for Q3, we're expecting to be down to flat year-over-year growth, maybe even below that at about 1% or so down, going down to the fourth quarter, which will be a big hit as well, close to 10% down on a year-over-year basis. And we still stay in that area. And you can sort of see in this next slide here, we stay in that area until we start getting into the fourth quarter of next year, where we start trying to see positive growth again. The next slide, please. So when we look at the midterm trends, I think one of the key points, if you can build out this slide, Lauren, this is what I think we're looking at, is the fact that we believe that suppliers in the channel itself, the channel that you participated, must continue to adapt and maneuver to the correction that we're currently seeing in the market, focusing on maintaining a position with strategic customers, leveraging technologies that really deliver a faster time to business value, a faster time to outcomes, and recognizing that the budgets will be tempered as and reevaluated as we go into 2023. We think the midterm updates also will really focus also on enabling scale with customers to address, digital transformation, because that will continue and electrification will continue as well, especially in industries like automotive and industrial. And we start looking at some of the vertical industries as well, like medical or health, and looking at retail. Some of these industries are going to continue to push their spending towards more automation, especially if it improves the operational piece of their business and reduces operating costs. I think in general, one of the things we're learning from some of the FutureScape research that we're doing at IDC is that, even though we might see lower spending that Lauren pointed out and that we pointed out in our data, organizations will still spend 8 times more than the overall growth of the economy next year on areas like operations, and a lot of that will center on silicon, hardware, and software. Even though that you're going to still see faster growth rates in software and services, but I think that's going to be very significant, and it really sets us well to and aligns us back to some of the long-term trends that we expect in the semiconductor space overall. On a longer-term basis, looking at over the next 5 years or longer, we're going to continue to anticipate that the timing of a recovery, you have to focus on when you think the market's going to recover, and then also continue to focus on some of the longer-term secular trends that we continue to believe remain very positive overall for the semiconductor industry, and that's really going to help address some of the emerging customers that we'll see during this period of time, and also will help organizations really secure the technology supply chains that are really become very vital to the world. And moving forward, the initiatives that we're now beginning to see, the seeds planted today that ultimately will lead to more regional sovereignty. And I think these are some of the more longer term trends that I'll highlight. Next slide, please, Lauren. So I won't spend time on this slide. I think Lauren covered this. And the only point I want to make is that clearly we still continue to see that IT spending will still grow faster than the overall macro environment. And you're going to start seeing more concentration of the growth in areas like infrastructure as a service and software and specific service projects that are existing out there. And the real negative impact are going to continue to be in areas like devices like PCs and smartphones, which will take a little bit more time to recover from the correction that we're seeing today, not just for inventories, but also demand. So as we look at the longer term semiconductor forecast, you can sort of see the impact of what our expectations are for next year. I talked about where we're at 2022, and you can see that we're expecting about 4.5% growth. So it's an industry that's still quite large. The industry that will equal about 612 billion in revenues this year, going to about 579 billion. But as we go into 2023, 25 and 26, we begin to see a recovery, a second half snapback of 24 for the semiconductor market. So we're looking at an overall annual growth rate of about 11%, and another almost equally strong year in 2025. And then you start seeing another, again, topping off in the market in 2026. But the point I want to make here is that we are getting back to where we expect to be by the end of the forecast period. We're looking at about an industry that's about 723 billion in size. Next slide, please. So some of the longer term trends I see, and I think that you're going to have to anticipate the exposure and risk that we're starting to see as the world continues to bifurcate. I think one of the things that we've learned over the last couple of years is that the semiconductor value chain is very vital to the overall movement that we're seeing towards digital transformation and electrification. I think when you look at the industry for whether it's semiconductors, this is a number from 21, but it was about 585 billion in size. But there are other components that are equally as important, and we're learning that as we continue to see the evolution of the U.S. Chip Act and ultimately the EU Chip Act and what's happening in Japan and Korea. But the IP and EDA industry, that's about 14.5 billion in size, but it's very critical to the overall supply chain. Looking at the RTOS and OS space, which is about equal in size. And then there's these other areas that are driven more so by the Asia Pacific region, which is the materials industry. And this is one of the things that we've uncovered that it's become very important moving forward. And it's an area that requires a lot more investment, especially if we're moving towards this more of a regional sovereignty. And this is an industry is about 60 billion, controlled heavily by the Japanese companies in the gases and substrate area, also by Korea and Taiwan and China. And we do have, of course, players in the US and in Europe, but they are not the incumbents. The incumbents really are in the Asia Pacific region. The wafer fab and tool area, that's about a $90 billion industry. And this is also going through a lot of change, especially as we start implementing sanctions. This is where you're going to see the impact of China as we restrict them from getting access to some of the leading edge equipment. But it does have a material impact to the companies in the US and in Europe who are the key incumbent leaders in this space. And it really opens up the room over the next 5 to 10 years for other emerging regions to begin to develop their own equipment in this area. It will take them 5 to 10 years to start getting to closer to par with some of these leaders today, but you are seeing some of this market be impacted again by some of the moves that we're seeing that are more longer term. Now, the OSAT area, this has become also a very critical area. This is the basically outsourced assembly and test. And this is about $51 billion market controlled today by an oligopoly of players. There's about 3 to 5 of them that control nearly 90% of this industry. But what's making this industry more important these days is the fact that the packaging and it is really shifting to more advanced packaging, because integration within the semiconductor industry now is moving from monolithic integration to packaging integration. And you're going to see a lot more investment by TSMC and Samsung and Intel in this space, but it really is changing the competitive landscape of this market. And it's going to be one of these critical areas that if you're thinking about the next generation of automotive components or the next generation of HPC, they're going to be using more of these advanced packaging that's going to come today primarily from Asia Pacific. So 85% of this industry today is controlled by the Asia Pacific region. And one player in general, ASC, with the combination of SPIL, controls nearly 40% of this market. And then finally, the foundry industry. This is an area that I think has fundamentally been at the heart of the US CHIP Act and the European CHIP Act that we're seeing today. And 85% of the most advanced technology is done outside of the US. So we have a long hurdle to go to really establish ourselves in this space. And really, it's only been Intel and maybe to a certain degree, Global Foundries that will have a position in this space when it comes into front-end manufacturing. But I think that what's missing within our own evolution in this area and in supply chain is the fact that, if you can go to the next slide, Lauren, when we look at this space, the reality is that 55% of the value in the semiconductor industry is not just in manufacturing, and it's actually coming from chip design, from IP, from the OSAT area, from material sciences. And that's where I think some of this investment really needs to go to really create a more successful ecosystem. I think in general, we're going to continue to see the fastest growing companies in the semiconductor industry continue to be fabless. And for the most part, they are. And I think one of the points that's important here is that almost 90% of the leading edge capacity is concentrated today in Taiwan and Korea. And 78% of the foundry business comes from supporting fabless companies in that ecosystem. So I think there's a lot of work to do. It's going to be a big challenge for the US and even for Europe to overcome some of these, what I would consider deficiencies, especially if they're only focused on manufacturing and not on the other value that I think the semiconductor supply chain brings to the table. Next slide, please, Lauren. I think one of the key slides I want to leave you here is this is a quick snapshot of the semiconductor industry by industry segment. So you can see each of these companies from the biggest to the one outside the top 20. A lot of the concentration of some of these companies really is in computing or in wireless. But as you move out and you start seeing the middle of the pack and even the folks that represent the top 20, you're going to find that more and more of the market now is moving towards wired infrastructure, towards industrial, towards automotive. And in some cases, there are companies like NXP and Infineon and ST Microelectronics or Renesas, where a larger and larger portion of their business is coming from what I would call operational technologies or the OT segment as opposed to the IT segment. And I think this is an important trend to continue to watch closely, because I think as we look over the next 5 to 7 years, a lot more of the semiconductor growth at a top line level will come from automotive and industrial and some of these non-traditional markets that we tend not to focus on as much today. And you can see that by the maneuvering that you're seeing from the companies that are trying to position themselves more so in automotive, like an Intel or NVIDIA or even a Qualcomm, to also industrial positioning of IoT, as opposed to just focusing on consumer IoT. There's a bigger push towards taking connectivity technologies, taking AI and taking compute into industrial segments in order to continue to push automation and push digital transformation and electrification. So this will continue to be an important trend. The next slide, please, Lauren. This is one of the key trends I want to leave you here because I think on a longer term basis, this is the exposure and risk that we're not talking enough about. I know we see a lot of news about the sanctions that are being put in place by the US towards China, but at the end of the day, this industry is very interdependent and not just from a supply standpoint, but also from a demand standpoint. And if you look at this chart here, what you're seeing is that this is the amount of consumption and the amount of business that these companies have in China. And you can see that a company like Intel or AMD, 25% of their business is coming from China today. And I'm talking about this is looking at it from a consumption standpoint. You look at a company like Broadcom, it's nearly 60%. And you go down the line, the exposure of the top 20 companies in China is very high at close to 58% of the business overall. And I think this is something that we're not addressing with what we're doing with the US CHIP Act or the European CHIP Act or any other initiatives that are around every region, is that we're not addressing the fact that this industry, China, is the largest market segment. It is the largest PC market, smartphone market, and automotive industry. And those three markets drive the majority of silicon on a longer term basis. So if you look at the next slide, please, Lauren. This is sort of China, this is sort of China being the largest consuming area. If you can go back, Lauren, please. Just want to make a point here that if you look at the last 5 years, China has gained almost 2 percentage points, despite all of this turmoil that we've seen between the US and China. At the end of the day, China is still growing faster than any other region. And if you look at this on a longer term period of 15 years, you can see that China has gained 23.4 percentage points of share in terms of overall consumption. So this is what we cannot change. We can sort of change the supply lines and try to make it and mitigate the risk that we saw during the COVID pandemic. But what we can't really change is sort of the demand pattern and reality that we're seeing, that China is the largest market to serve. And the semiconductor companies have to figure out a way to continue to not allow that to disrupt their business. Next slide, please, Lauren. One of the key slides and one of the points I made earlier was that when you look at the entire capacity of our industry, it's pretty equaled out between IDMs, which are integrated device manufacturers. A good example would be Intel or ST Microelectronics, a memory company like Samsung or SK Hynix or Micron, and then the foundry guys like TSMC, UMC, Global Foundries, and some of the upcoming players like IFS, Intel. So you look at the capacity is pretty mixed up between these three sectors. But what's interesting to point out is that when you start looking at the capacity by maturity, over 2/3 of the capacity is still in a lot of these legacy technologies. And this is what we saw the most constraint over the past 2 years. And we've been sort of reluctant to invest in this area until recently in 2021, where we're going to see some of that capacity come online now and in 2023 and 24. But I just wanted to give you sort of the structure of what we're seeing in terms of capacity. If you go to the next slide, Lauren. This next slide really is to illustrate sort of where the investment is going. And you can sort of see that the big players like TSMC and Samsung are going to continue to move and not only continue to support mature and mainstream technologies, but really moving more and more towards the leading edge. If you look at capital spending on a longer term basis, 80% of the capital spending is going to leading edge technologies, which are 14 nanometer or 16 nanometer and below. And the rest, the other 10% is going to advanced packaging investment. And then the remaining 10% is really towards legacy technologies or mainstream technologies. So you can see that a lot of the concentration of the players that I would consider more tier 2 players and below, they're still going to continue to focus a lot of their investment plans around mature technologies because that's the core base of their customers. That's where you're going to find sort of the analog markets or the image sensor markets or the LCD controller areas. But if you're looking at AI, if you're looking at compute or the next generation of mobile SoCs, that's going to be dictated by the investments that TSMC and Samsung are making on a longer term basis. And I want to point out that at the bottom, as you look at between 24 and 25, you're going to start seeing that's when Intel makes an inflection point in the market because that's really their entry point. A lot of the talk about Intel coming into the foundry space today is very premature. they have made an investment. They've acquired Tower, and once that deal goes through early next year, they'll definitely inherit about 1.5 billion of revenues and over 200 customers. But they still have to build out the real customer base in order to compete against the two leaders. And so this is where we see the pecking order. And I think one of the things I want to leave you with is that the investments in technology are very clearly weighted towards the leading edge. But I do believe that the mature technologies are still very vital to areas like automotive and industrial, and even to the mobile phone area. You can still see a tremendous amount of components still relying and dependent on mature technologies to be able to build out their entire BOM. And we're seeing some interesting dynamics. We do believe that TSMC and Samsung will continue to invest. And one of the things that they're also trying to do is accelerate some of their customer base towards FinFET technologies, which are more around the 16 nanometer range and below. And that's going to be interesting to watch, because if that happens in the next couple of years, it does disrupt the maturity area on a longer term basis. But we'll see how that goes on. But I just wanted to give you a quick illustration and more of a longer term trends that we see for the market overall. And then finally, if I can go to the last couple of slides, this is sort of the foundry market outlook. I talked about the fact that we're seeing a deceleration in growth. Utilizations will drop, mostly for the tier two. I think TSMC still will have some impact because of Apple and a couple other companies begin to push out some of their orders. But in general, I think they'll perform better and they'll have higher utilization rates than the peers that they compete with. But we do not see an reacceleration of utilization until in revenues until we start getting into the second half of 2023 for this space. And this space in general will perform better than the overall market because it typically grows at 1.5 to 2 times faster than the overall semiconductor space. My final slide. So as I conclude this talk and I look more long term, I think despite a lot of the near term challenges and sort of the moderate recession that we're factoring into our numbers, and really the fact that we're seeing negative growth next year, when we look at this space from a longer term perspective, the semiconductor content is still growing across many system areas, which I think will continue to bode well. Whether you're in automotive or industrial, we're seeing a lot of transformation, a lot of movement towards electrification, towards sustainability. And the foundation of a lot of those trends really still centers on the semiconductor space. We think that we're going to reach $1 trillion in size over the next decade for the semiconductor space. And, we calculate that it will happen sometime in 2032 or 2033, which seems like a long way away. But what the reality is that requires a lot of investment today, because the decisions that are and roadmaps that are being put in the semiconductor space are roadmaps that take you out 5 to 10 years. And so we believe that that type of revenue, when we reach that level, will require twice the level of investment that we see today, not just in capital spending and building out these fabs, but also in design, in IP, in packaging, and also in R&D spending. So that's going to be an important fuel that I think will continue to drive innovation for the semiconductor space. And I think I'm very positive on the long-term trends of the semiconductor market. Some of the key market drivers will continue to be electrification and digital transformation. The HPC market is undergoing a lot of change as well, and a lot more sovereignty around where we build our cloud, where we build our edge infrastructure. I think that's going to be important to watch, but that's also a good opportunity for silicon. Next generation connectivity. Today we're still sort of in the 4th or 5th inning of where 5G is, but 6G will start coming into the market by the end of this decade. And I think that's going to be important to watch. The transformation that we're seeing in automotive, and the reality that we're also moving towards more and more systems becoming either semi-autonomous or fully autonomous, and in order to drive more, not just innovation, but automation. And we think that these are very important long-term drivers for the overall market. And just one last point I want to leave you is that when I look at the space over the next 5 to 7 years, I think 1/3 of the demand will come from the automotive space and the industrial markets. And so you're going to see, because of that, you're going to see a lot more investment. And as this industry corrects, you're going to see a lot more consolidation in the space, and new players will emerge, or companies that get much bigger in order to try to address these market opportunities moving forward. So with that, I conclude my presentation, and thank you very much for your attention.
Well, thank you so
Thank you,
much for
Mario.
that. And as usual, you see the contact details here for Lauren, for Mario. You can reach the GTDC through our website, or our email addresses. If there's any kind of themes or topics you'd like to see us cover in the future, please let us know. The IDC team is quite a vast number of analysts with expertise all over any kind of tech field. So let's take advantage of that and hear their thoughts and their analysis around there. So feel free to send me a chat or send me an email. Frank, any last words here?
Thanks, everybody. Appreciate you hanging in there. There was a lot of information, but a lot of good stuff here too. So we'll continue to do these. Thank you.